With high interest rates and recent tax changes announced by the government, HMRC expects to collect much more tax revenue from savings interest than before. A lot of people will end up paying this tax because they are not aware of things they can do to protect their savings interest from being taxed. In this video, I will explain how savings interest is taxed, allowances available for savings interest, and strategies that you can implement today to legally avoid paying any tax to HMRC on your savings interest. Hi, I'm Sabina. I'm a chartered certified accountant with diverse experience gained at one of the top UK accountancy firms and in the industry. On this channel, I share knowledge and strategies about finance, entrepreneurship, and self-development to help you achieve your financial goals and build a life you truly love. If that's something you are interested in and would like to learn more about, then please subscribe to my channel. Number 1. Why more people will be paying tax on their savings interest? The first reason is fiscal drag. The amount of money that you can earn and do not pay any tax on is 12,570. That's called your personal allowance. That's been frozen until the 2030-2031 tax year. As salaries increase and people are earning more, this means that more of their salaries will be taxed. This is effectively a state tax because it results from something called fiscal drag. By keeping the thresholds at the same level while salaries are increasing, more people will be pushed into paying tax at the higher rates of 40% and 45%. And if you are not paying any tax at the minute, because your salary is below 12,570, you are more likely to be pushed into paying tax at 20% for the very first time, as your salary exceeds your personal allowance. In addition, you will have to start paying tax on your other income, such as savings interest or dividends. You might not be aware that you have to pay any tax on your savings interest because your bank will tell HMRC how much interest you received at the end of the year, and HMRC will automatically change your tax code and deduct any tax that you owe from your salaries through pay-as-you-earn. The second reason is rising interest rates. Bank of England interest rate has significantly increased in the last few years, and now you can find banks that offer savings accounts that pay 5% interest on your cash balances. That's a good way to earn some passive income, but your savings interest could be at the risk of being taxed if you exceed allowances available for savings interest. In addition, this extra interest could increase your total taxable income and push you into higher or additional tax bands. Number 2, tax on savings interest. Interest earned on your savings is taxed at your usual rate of income tax. They are 0% up to £12,570, 20% up to £50,270, 40% up to £125,140, and 45% above £125,140. However, the government announced that tax on your savings interest will be increased by 2% across all bands from April 2027. Number 3, allowances available for savings interest. There are some allowances available for savings interest before you have to pay tax. First allowance is the personal allowance of 12,570, which I talked about earlier, that you can earn tax-free. This means that if you haven't exceeded 12,570 with salaries, pension, or other income, it can be used to shelter your savings interest from tax. Second allowance is starting rates for savings, which means that you can earn up to £5,000 of your savings interest tax-free. But it's only available if your total income is less than £17,570. And for every pound that you earn above your personal allowance of £12,570, the starting rate for savings allowance is reduced by £1. Final allowance is personal savings allowance, which lets you earn £1,000 of your savings interest tax-free if you are a basic rate taxpayer, £500 if you are a higher rate taxpayer, and it's reduced to zero if you are an additional rate taxpayer. As salaries increase along with inflation and people earn more people will end up being tipped over into those higher and additional tax bands. Because of that, a lot of people won't have any of their personal allowance left, won't qualify for starting rates for savings allowance, and will only have £1,000 or £500 of their personal savings allowance available to use. Number 4. Strategies to avoid paying tax on your savings interest. There are 3 simple strategies available to most people to legally avoid paying any tax to HMRC on their savings interest. The first strategy is to utilize your personal savings allowance. You can avoid paying tax on your savings interest if you keep your savings interest below a certain threshold. This will allow you to compare interest rates on savings accounts across many providers using websites like Money Savings Expert or Experian, and choose a bank that offers the most competitive interest rate. For example, if your bank offers 5% interest rate on your savings account and you are a basic rate taxpayer, you can deposit £20,000 and earn £1,000 in interest in a year tax-free. And if you are a higher rate taxpayer, you can deposit £10,000 and earn £500 in interest in a year tax-free. The second strategy is cash ISA. You can avoid paying tax on your saving interest if you keep your money in a cash ISA, which is an individual savings account. It is a tax wrapper, which is a tool designed to help individuals shelter their savings from tax and ultimately maximizing their wealth. You can save £20,000 in a tax year into your cash ISA and do not pay any tax on the interest that you earn on that cash. This limit will be reduced to £12,000 from April 2027. In a current economic environment and rising interest rates, cash ISA are becoming more relevant to those with high enough cash balances that the interest they earn exceed their personal savings allowance of £1,000 or £500 that I talked about earlier. The third strategy is to invest in stocks and shares. The interest rates on your cash in your savings accounts is generally lower than the inflation rate. Investing in the stock market has historically been the best way to keep pace with or beat inflation. General guideline in a world of finance is to keep between 1 to 6 months of your fundamental living expenses in cash. That's your emergency fund in case something goes wrong, like unexpected job loss or house or car repair, and to keep any other amount in cash if you plan to use it in the next 5 years. For example, a house deposit or a wedding fund. And you need to keep these funds in an easy-to-access and high-interest savings account. For long-term goals, investing offers a better chance of positive inflation-beating returns. For example, a popular index fund, S&P 500, has an impressive average rate of return of 10%. This is much higher than the interest rates that banks are currently offering on savings accounts. A tax-efficient way to invest in the stock market is to invest through Stocks and Shares ISA. You can save £20,000 in a tax year into your Stocks and Shares ISA. That's the amounts shared between Stocks and Shares ISA and Cash ISA, and not pay any tax on your investment returns. This means that the money you make when your investment value increases, called capital gain, or when you receive a dividend income, are not subject to tax. If you found this video helpful, please let me know in the comments below, and I would appreciate if you subscribe to my channel. If you like this video, you might also like this video where I explain new tax system called Making Tax Digital, coming from April 2026, and what it means to you if you are a sole trader or a landlord. I will see you there.